As a disappointing third quarter draws to a close, economists seem to be in agreement on only one issue. That is that the economy has seldom been harder to read. Analysts are emphasizing a whole range of indicators and coming up with mixed messages. Francis Kelly has been with us before. He is now the Chief Investment Officer of Boston's Putnam Management Companies. Thank you for joining us. I know you got a late flight last night. Thanks for coming in. Let me start you off with some of the downturns. Housing's down, investments off, growth rate's minimal, unemployment's stuck. Farming's off, textiles off, oil production's off. Yet you were telling me earlier you're optimistic. Why?
I think, Brian, what's happened is that over the last 2 years, ending roughly the middle of this year, we had enormous downward pressures on economic activity, centering principally on the trade deficit, but also a major runoff of inventory. My belief is that both these negative forces have largely run their course.
Have they? Why? What makes you say they've run their course?
In the economics forecasting business, obviously some of the critical turning points are not easy to demonstrate at the time. There's very limited evidence, so partly your judgment is intuitive. But in essence, my contention is this. We've had an enormous decline in the dollar exchange rate against leading currencies over a period of roughly 2 years, down about 50%. We have no experience in this country with a decline in the dollar of that magnitude over a concentrated period. But the predictable effects, looking at other nations, is that roughly 2 years after you have this enormous decline in your currency, you're going to see the beginnings of a significant revival in industrial activity. I think that's the general proposition I would offer. The specific one, if I may just say, is there's now some anecdotal evidence in areas like technology where there's strong international competition that we're beginning to turn to a stronger new order pattern.
Let me look at the same evidence and offer a different scenario and have you respond if you would. Okay, we've got a decreasing dollar, we've got decreasing rates, we've got low energy prices. All of those things generally spur the economy, yet they haven't. Why?
Let me get back to the key thing. It is, in fact, the exchange rate relationship. There is no historical experience in this country for a $200 billion deterioration in the external accounts, in the trade accounts. And what we're going to see, in my contention, is a change in the pricing of U.S. competitiveness versus the rest of the world. This country has the cheapest industrial asset base of any major industrialized nation. What this means in turn is two things. We're going to see a rise in new orders to exploit that cheap industrial asset base, and we're going to see, in fact we've already begun to see this year, the beginnings of a major infusion of funds from outside this country into purchasing these assets. So foreigners have much more confidence, if you want to phrase it that way,
we do.
In the prospects for the industrial economy than we do.
What about rates? I mean, we saw the Fed drop at a half point down to 5.5. Banks responded a little slower than they normally would. This was the fourth time they've tried to spur the economy on with a cut. Is that it? I mean, have rates about bottomed out?
I think they're probably about bottomed out. If you share my view, which few do, but if you share my view that industrial activity is about to pick up, I don't think there's much more downside potential for rate declines. But the key, I just want to repeat, Brian, industrial prospects next year depend not on further declines in interest rates, nor on the prospects of tax reform, its effects on the economy, but on whether we're going to regain shares of world markets. I strongly believe the evidence supports that.
Why are you so quick to downplay the uncertainty surrounding tax reform?
I don't downplay them, but I think it's a diversion at this point. People are distracted by it, when the real issue is 2 years of very dramatic declines in dollar exchange rates, now about to have a major impact on industrial activity. It's much more important, in my opinion, than the effects of tax reduction.
Well, couldn't somebody argue that it may truly be the real issue, and they're looking at a tax bill where business may have to come up with another $120 billion over the next 5 years? I mean, isn't that going to force prices up? Isn't that going to cost jobs?
I think it's an arguable issue, but the important part, I think, is that the tax reform has the effect of cutting taxes for the individual by the same amount, of course, as it raises at the corporate sector. And in my opinion, what we saw back in '81 was, with that tax bill, overly generous depreciation allowances that really had no effect on economic activity. We didn't have the capital boom that was predicated on it. So we're taking some of that overly generous depreciation back, giving it to the consumer. We know the consumer is going to spend the money. I think that's a reason for being bullish about the prospects of the tax reform bill, not cautious.
You sound like you're siding with the supply-siders who say the investment and the spending that we're going to get as a result of the tax savings is going to spur the economy. You really think
I think it's just reasonable. I don't know what label you give it. I don't think it matters. I think it is a reasonable interpretation.
And it seems like we've been asking the same question forever, but at what point does the deficit jump up and bite us? We have about 30 seconds.
I'm not sure that it does. I think it may be a necessary long-term element in this economy.
Francis Kelly, it's always a pleasure.
Nice seeing you,
Thanks
Brian.
very much for being with us. 22 past the hour. We're going to come back in just a moment on this Thursday morning after a break. This is Today on NBC.